We live in a highly globalized world. That means whatever happens in one part of the globe is bound to go and affect the other parts as well. And this is equally true for the monetary policy. In the globalized times that we are living in, monetary policy is not domestic, it is global. And the epicenter of this global monetary policy effects usually starts from this very institution, that is US Federal Reserve. US Federal Reserve had decided to not change the rates. They have maintained silence on this, and the world is watching that silence because the ripple effects of multiple things begin from that very place. Hello everyone, welcome to Vajiram and Ravi's Flash News. My name is Shubhangi Singh, and today we are going to understand that why the US Fed Reserve rate decision is so important for the global economy. What it means when they have decided to not change it this very time, and how it can materialize later. So let us begin with understanding that what exactly has happened. So US's central bank, that is Federal Reserve, has decided to make no changes to the interest rates. They have decided to keep it in the range of 3.50% to 3.75% range, which was before this. So there has been no change at all. And when we are talking about this no change, a lot of people might perceive this as that this is an indicator of stability. However, at the present, the scenario is starkly opposite, because we are talking about a time where US is part of a war already. We are talking about a time where oil prices are rising, and we don't know when this conflict will end and oil prices will be stabilized. And we are also in a time where the global trade, global inflation, geopolitics, all of these are variables. There is no predictability and stability attached to all of it. However, still the policymakers have predicted that yes, there will be higher inflation, because of which the policy rate has not been changed, but there is a possibility that it might be changed once in 2026. So given the rising Iran situation, given the persistent inflation and increasing oil prices, US has decided to go into wait and watch monetary policy stance. And this is very important, as the saying also says that if the Federal Reserve sneezes, the global landscape catches the cold. So let us try to understand that what exactly we mean. What exactly is the dependence of globe on US monetary policy, and also let us try to understand how this is linked with geopolitics and economics. So we will start with the economics part, understanding that what is the correlation that exists between the Fed rates and its effect across the globe. So let us talk about interest rates first. When we are talking about interest rates, they are the ones which decide the returns. So let's just say you decide to deposit your money in the bank, and if a certain bank is giving you higher interest rate, you will definitely choose the bank with higher interest rate and deposit your money there. Similarly, when we are talking about an economy as huge as US, where its currency is also globally dominating and it is also seen as a global reserve currency, US becomes an epicenter when we are talking about interest rates and the ripple effects that generate from there. Let us break that down. So when we are talking about global reserve currency, US dollars, it is one of those currencies which is highly used for oil and trade, not just in US but across the globe. So if there are any changes at all in the interest rate in US's economy, it is not going to affect only US, it is going to affect the global liquidity that is associated with US dollars. It is going to affect the capital flows, it is going to affect the exchange rates as well. Now let us understand how. Let's just say the interest rates in US have been raised. People would be inclined to invest more in US. That means there will be movement of capital. People would want to go, investors would want to go to US. It will lead to capital flow. If the interest rates are increased, then the money moves to US. If they are reduced, then money moves away from US. If in a situation when people are readily investing in US economy, dollar would be demanded more. That means dollar as a currency will be strengthened. That means there will be an impact on exchange rate as well. If interest rates are high, it is not just for deposits, it is also for borrowing. So it is going to impact the borrowing cost not just in US but also across the globe, because global loans are also linked to US interest rates. And all of this is also going to impact financial markets. How it is going to impact financial market? Because of the movement of capital here and there, it is going to affect the sentiments of investors, it is going to affect the stock markets, it is going to affect the bonds accordingly. So that means a lot is generated the moment interest rates are revised by US Fed Reserve. In order to understand this, let us look at this given diagram. Let's just say Federal Reserve of US decided to increase the rates, okay. They have decided to increase the rates. That means the new bonds which will be coming out, they will be paying higher payouts. They will be giving better dividends. Now, if investors want better dividends, better returns, then they will move towards US bond yields. That means there will be a global capital flow shift that will be occurring. Now, once that shift will be occurring, if the movement is towards dollars because the interest rate has increased, that means dollar will strengthen. If dollar is strengthening, think from a perspective of an emerging economy, be it India, be it Brazil, what will be an impact on them? If the demand of US dollar is increasing, rupee is going to take a hit. If the movement of capital is towards US, then the capital from India might be reducing. And if we are also taking into consideration the stock markets, if the investors are moving away to the other markets, stock markets also might take a plunge. But all of this will reverse if the Fed rates are decreased, and nothing will change at all if it is kept on hold, which has been seen in this given scenario. But the problem here is when we are saying that it is at hold, unfortunately at this time it does not indicate a stable situation. It indicates that a lot is coming, a lot is going on, and that is why it is a better decision to wait and watch and then decide what we want to do of the interest rates. Now that we have a fair idea that how basically Fed rates matter globally and how they impact globally, let us also further understand that why Fed decided to not change the interest rates this time. If the interest rates are given a cut, that means if interest rates are reduced, that means the borrowing cost will reduce, there will be more money in the economy, and also there will be capital outflow. But at the same time, the government cannot risk more money in the economy because that will go to increase demand. People will have more money, they would want to buy more, but already because the prices are high and the demand will shoot up, then prices will go further high. So as of now, inflation is already above 2%, which is the target of Fed Reserve, but at the same time, because of the oil price rise situation, the Iran situation, further inflation is expected. And at this time, if the rates are cut, then borrowing becomes easier, then money supply will be more in the economy. Now money supply more in economy, people will want to spend, they will demand will go up, but supply is the same. So what will happen in this situation? Further price rise. And that is not something that government wants. That is why government is refraining from any rate cut. Another situation here is, as of now, there is weak job market which is present in US. Slow employment growth is present and there is already risk of recession. So if the government wants to give an impetus, they would also want to consider this. That is why they have decided to hold it. They might have to consider, but look at this. When we are talking about rising inflation but limited growth, this is a situation of stagflation which is present. So US still wants to understand that what is unfolding and then decide which problem they want to tackle first. There are other reasons as well in front of US, such as definitely the Iran war and the supply side inflation as well. Because the inflation is not only coming because of demand, the production, the supply, the prices there have gone significantly higher. You have to remember that US has put in tariffs. You have to remember that tariffs means more expensive product in US market coming from outside. At the same time, the higher energy prices are also present. So all of these, now this side especially of inflation, this cannot be controlled by interest rates. So this is something that monetary policy needs to be very considerate, because of all the factors that we have talked about US Fed, they are very complex. Now let's straight away jump to the situation where we want to understand that how it impacts India. Because as we discussed, whatever happens in US Fed Reserve, it is going to have an impact on emerging economies. And when we are talking about India, in this situation, when we are talking about stable US rates, it comes with certain positive outcomes, such as there will be no sudden capital outflow. Let's just say if US Fed Reserve had increased the rate, there would have been outflows. And just because there are no outflows, we have stock market stability, we have relatively stable rupee, which has suffered recent plunges in last week because of the Iran war and other volatilities. But at the same time, there are risks that we need to consider. Just because we have stability as of now doesn't mean there are other factors, such as rising oil prices. Rising oil prices means import bill will increase. So either way, we have the pressure of inflation on us. We have the pressure of current account deficit, we have the pressure of fiscal deficit, we have the pressure of rupee taking a plunge because of this burden itself. And amidst this, RBI is also taking a hold as of now and looking towards what kind of stance they can take up. As of now, rate cuts are not in the scenario, but what might unfold will be seen based on our domestic situations, but also the global situations, such as what actions are taken by US Fed Reserve. I hope you have got clarity on this particular topic. If you have any doubts, you can put it down in the comment section. That was all from my side. Thank you so much.